Alan Murray, economics correspondent for the Wall Street Journal. People watching the stock market in the past couple of days might be tempted to use the word roller coaster. Is it over?
Well, I don't know if it's over, but I think the word roller coaster would certainly be an appropriate one. I mean, we seem to have reached a period where the stock market's become disconnected from reality and from the real economy and has these wild swings on its own. It's certainly a little unsettling.
Would you spend a little bit of time and explain to people exactly what happened on Friday and then again on Monday? Sure.
A couple of things happened on Friday which seem to have laid the groundwork for the collapse of stock prices. It started early in the morning when some bad inflation numbers came out. There were a couple of other bits of news during the day, but the main piece of information came out around between 2 and 3 o'clock when it was announced that a buyout plan by the management of United Airlines to buy out their company, to buy out United Air, had fallen through. It hadn't gotten financing. That caused a lot of institutional investors to fear that a lot of these takeovers, Donald Trump's plan to take over American Airlines, might also fall through, and the stocks that had been pumped up by all this speculation about takeovers suddenly started to collapse. And in the last hour of trading on Friday, you saw prices drop 190 points. So it was a very, very sharp drop and a very fast one for that to happen in 1 hour. Then I think what happened over the weekend was people regrouped, they looked at the situation, they said really there's no fundamental change in the economy here, maybe some of these takeover stocks aren't worth as much as they should be, but there's no reason that all the other stocks should be dragged down in the process. On Monday morning there was some backup of sell orders, people who on Friday afternoon had wanted to sell but couldn't, and so when the market opened on Monday morning it started going down again, went down about 60 points, but by 10:30 it was all over.
I want to pause for a minute. I know our lines are going to be very busy, and I don't want to spend too much time asking you questions. I'll let the callers do that. But let me tell you how to do that. 202-628-2525 if you live in the Eastern and Central time zones. 202-783-2727 if you're watching in the Mountain and Pacific time zones. And please remember, if you're calling in this morning, that we have a 30-day policy. That means you can't call if you've called within the past month. Let other people have an opportunity to get through and ask their questions this morning. I want to at least start with talking about some of the outside influences on the market. One we're most familiar with here at C-SPAN, and that's what's happening in Washington with fiscal policy. Obviously, the Congress was unable to meet its targets. The sequestration has begun. Did this have an effect on what happened with the market?
Well, I think it would be wrong to say that anything that happened in Washington actually triggered the stock market collapse. But if you talk to people on Wall Street, you do get a sense that there's a feeling that that economic policy in Washington is a little bit out of control, that nobody seems to be in charge. There's no real leadership. As you mentioned, last night the President signed a sequester order, automatic across-the-board spending cuts to go into effect immediately. That's kind of government by autopilot. For the last few weeks, we've had a semi-public spat between the Treasury and the Federal Reserve, which I think has disturbed a lot of people on Wall Street. And we've also been having a struggle over these airline buyouts. Transportation Secretary Sam Skinner has said we shouldn't allow our airlines to become over-leveraged. We shouldn't allow foreign companies to buy into our airlines. Other people in the administration feel differently, and a lot of people at the banks and on Wall Street are confused about what Washington's policy is.
Then I would also like to talk about the Federal Reserve. One thing that the Fed did differently this time than 2 years ago, which is known now, I guess, as Black Monday, was announce that they were ready to infuse cash.
Well, that's a very, very interesting situation. In fact, the chairman of the Federal Reserve, Alan Greenspan, didn't announce it, didn't authorize any announcement, didn't want any announcement to be made, and was very angry Sunday morning when he woke up and saw in the Washington Post and the New York Times that some, quote, senior Fed official had said that the Fed was ready to pour cash into the market. I think there may have been a little bit of a struggle going on at the Fed among those people who did want to make this announcement early and those who didn't. It of course was true that had there been a collapse in stock prices on Monday, the Fed would have been ready to do what it did in October 1987, and that is pour money into the system to make sure that the financial system stays afloat. As it turned out, they didn't have to do a whole lot.
How did that, you've watched this city for a long time, how would it happen that the chairman would see an unauthorized story appear in the paper?
Well, the Federal Reserve is a very interesting institution. It's made up of 7 board members, each of whom is appointed by the president. So right there you have 7 reasonably independent policymakers who may have differences, do have differences about how things should be done. So if the chairman may decide he wants to make no announcement before Monday morning, but it's possible that one of the other board members thought otherwise.
Chairman Greenspan appeared in Washington before the American Bankers Association. You wrote about it in his public appearance right in the midst of all this. What kind of a public persona or stance did he take?
Well, first of all, it was very cautious. I think if he thought he could get away with it, he would have canceled the speech. But everyone in Washington over the weekend was very careful not to cancel trips, speeches, anything like that, because they didn't want to create a perception that they were panicking. So this was a pre-scheduled speech. He decided to go ahead and give it. He came out and at the beginning of the speech he said a couple of things. One was he said that comments he had made in Moscow a week earlier, which were interpreted by some analysts as disagreeing with the Treasury Department over dollar policy, he said that those were misinterpreted. He wasn't trying to say anything about U.S. policy. And he joked that he hoped his friends at the Gosbank in Moscow wouldn't interpret anything he had to say in Washington today. That was partly an attempt to calm the markets. The other thing he said was that he had been working very closely with the Treasury Department, the Securities and Exchange Commission, and they had been watching the markets closely and tried to give people a sense that he was on top of the situation.
Last question for you before calls, and that is on foreign countries. Now, you mentioned that this United Airlines deal was actually based on foreign investment, Japanese, I believe.
There was some in the United deal. There was some British investment involved.
Well. I heard an analysis that the effect that the collapse of this deal had on the market was some indication of how much influence and what the effect could be of foreign investment, how much our own economy in this country depends on foreign investment.
Well, I don't know if this particular deal is a good example of that, but it is certainly an incontestable fact that we have become hooked, addicted to foreign investment. We don't save enough in this country. More than half of what we save, we soak up for the federal budget deficit. So there's very little money left over to put into investment. So we have to bring in over $100 billion a year from abroad just to keep our economy afloat. A lot of it's coming from Japan, some of it's coming from Europe.
As a matter of fact, to clarify a statistic, saw recently in an article that England is in fact the largest foreign investor in the United States right now.
That's right, but I suspect that won't be right for long. If you look at the growth figures, the Japanese are right on top.
Let's go to the phones. First call is from Portland, Oregon. Good morning.
Good morning. Mr. Murray, as one of the authors of Showdown at Gucci Gulch, which is about the politics of tax reform of '86, I was wondering, as these proposals came forward about IRAs and cutting capital gains, what was interesting, because a lot of the players that now were players then, and as you heard the various statements come out from the various people, what struck you as being most interesting in terms of what changes people might have gone through or how they felt about tax reform was working out?
Well, I'm not sure I'd call it interesting. I mean, in some ways, it's unfortunate. I think if you watch Congress this year, you have to come to the conclusion that the 1986 tax bill was an anomaly. People like Senator Bob Packwood of Oregon, Senator Lloyd Benson of Texas, got caught up in the tax reform movement of the moment, but were never truly committed tax reformers. And so what you see now is Congress gradually picking apart that bill they put together in 1986, and I think that's probably a shame.
White City, Florida. Good morning.
Good morning. I have a question for the gentleman. I'd like to know what bearing he feels that the congressional handling of the massive savings and loan investigation, final committee hearings, which left Jim Wright and Mr. Kaleo off the hook. on their responsibility for that ever-growing fiasco, and the ultimate bailout himself of $160 billion had on not voter confidence, but investor confidence in the stock market, and by that I mean the very integrity of our financial institutions, be it the stock market or our savings and loans or banks, determines greatly on what happens in our legislative branch of government, I feel. And since it has been proven that they will use political means at the highest level to manipulate a very important infrastructure of our entire economy, I, for one, who was beginning to consider investment in the stock market, for example, with my savings, hesitated to do so. I am very hesitant about what I will do with my money, quite frankly. I'm very concerned, and I think many others share that same concern. And I would like to know what bearing you feel that very influential political mishandling, such as we had in the case of Speaker of the House Jim Wright, Mr. Kaleo, with the savings and loan, in that they delayed the...
I'll tell you what, why don't we, you had a chance to ask a long and involved question, and why don't we let you go at that point and we'll get an answer.
Well,
Thanks.
I agree completely with the caller. I think the savings and loan fiasco is really one of the saddest chapters in our nation's financial history, and there was a lot of political... there is a lot of political responsibility to spread around, not just former House Speaker Jim Wright and former House Whip Tony Coelho, but a lot of other people too in both parties who year after year delayed addressing this very serious problem because they were being supported, being given large campaign contributions by savings and loan executives. They allowed it to build up until it's now $50 to $100 billion problem. I don't think, though, that had anything to do with what happened in the stock market on Friday, only because we've actually finally started to clean that up a bit. We're in a better position today on that score than we've been in for the last 5 years. But I understand the caller's frustration.
On that note about Washington, there was a story with your byline in the Monday edition of the Wall Street Journal with a very long headline. Stock market's plunge leads to finger-pointing in Washington, but barring further slides, isn't seen as likely to spark action. What were you saying in this piece?
Well, some of the things I mentioned earlier, that there is a sense on Wall Street and elsewhere that nobody is in charge of economic policy, that there's a lot of confusion about where things are headed and what should be done. But the other thing is, remember back in 1987 when the stock market crashed, we had a similar situation. The sequester, the automatic across-the-board spending cuts were just starting to kick in. There was no progress being made on the budget. And when the market crashed, you actually did get a group of leaders together to sit down, Congress and the administration, and make some progress on the budget. One of the things we're saying here is that that's not going to happen this time, partly because they've been through it before and they found out the world didn't fall apart, and partly because it wasn't as big a slide in the stock market.
Mill Valley, California, good morning.
Good morning. I view Wall Street actually as the sacred center of worship of the god of materialism and greed. And my question is, why don't we, for a change, do something creative, like tax the big casino? I'm really tired of that.
Well, it's an interesting suggestion. Wall Street may be the center of greed and the big casino, but it's also where our nation's companies have to go to raise the money they need to invest and to create jobs and to grow. So you have to be careful about how you do it. But I think you're right in the sense that it used to be the stock market was made up of a lot of individual investors making decisions about whether to buy or to sell on their own. Now what you have is a handful of these giant pension funds, giant institutions run by people who probably spend too much time having lunch together, have a herd mentality. You throw into that computer trading, and you get a tremendous amount of volatility, as we've seen over the last few days. There is a proposal that's been made by Senator Nancy Kassebaum, a Republican senator from Kansas, to tax the pension funds on their short-term trading. That proposal is also being carefully studied in the Treasury Department, and I wouldn't be surprised if you see something like that surface next year that might get at what you're talking about.
Deerfield, Illinois. Good morning.
Good morning.
You're on the air.
I just wanted to make two comments and just ask you to comment on that. I really feel that the underlying volatility of the market is due to two basic things. One of which is the ever-changing prime rate and discount rate. It changes maybe 7 to 10 times a year. And the other is the changing or potential changing of the tax law all the time. So that when no investors have confidence in what's going on with the government. So I'd just like to hear your comments about that. Thank you.
Thank you.
Well, certainly interest rates do move up and down, but actually in the last couple of years we've had much smaller movements in interest rates under Federal Reserve Board Chairman Alan Greenspan than we had in the past under former Fed Chairman Paul Volcker. So in a sense, I think we see some more stability in interest rates than we've had in quite a while. On the question of the tax law, I think you're absolutely right. We've had a major tax bill every year. We're now seeing the unraveling of the 1986 tax bill. The chairman of the Ways and Means Committee, Dan Rostenkowski, said in 1986, after that tax bill was done, that he was going to put a gone fishing sign on his door for the next 5 years. I think a lot of people wish he had.
New York City, good morning.
Hi, I want to, as they say in Congress, associate myself with the comments from the lady from Mill Valley. I think it's also a big casino and that basically a playground for rich people, and the rest of us are kind of left out here swinging. And I'd like to draw your attention to a very interesting op-ed piece in today's New York Times by Theodore Cito. I don't know if you saw it or not. He's a tax lawyer from Philadelphia and has said that basically this capital gains tax cut is a big giveaway to rich people and will make his job much easier in terms of finding loopholes for the rich. And basically us, what he says out here, so we win, meaning the tax lawyers, the wealthy win, and you end up dumb and happy voting again and again for people who keep on snookering you, meaning us small taxpayers out here in the world. This capital gains cut is not for us. It does nothing for us. The SNL bailout, where certain politicians whose names will be shortly revealed because of books like The Big Fix, which will be coming out soon, will tell us all about who these politicians were and the kind of egregious sins they committed against this country. And I certainly hope that some of them go to jail. And could you explain to me why Drexel, Burnham, Lambert still has their seat on the exchange and they're not all in jail?
Thanks for the call.
Well, I'm very sympathetic to a lot of the things the caller said, but these things are not quite that simple. For instance, there are a lot of us, you may be one of them, who have an enormous stake in the stock market through your pension funds or mutual funds. And so, you know, anything that's done to hit the stock market could hit you indirectly. And again, you look at Drexel Burnham Lambert, well, there are charges that Michael Milken, the head of junk bond trading for that company, has done some things that were illegal. He's under investigation, and I hope if they find that he did, that he will suffer. But Drexel Burnham is also responsible for a remarkable revolution in financing, which has enabled a lot of medium-sized companies that in the past didn't have access to the bond markets, couldn't raise money in the bond markets because it was strictly a big boys game, and he made it possible for them to do it. So there are a lot of people out there who are very grateful to Drexel Burnham for creating jobs and for creating some smaller, medium-sized companies that wouldn't have had an opportunity without Drexel Burnham. So there are two sides to the sword.
We're talking with Alan Murray this morning. He is an economics correspondent for the Wall Street Journal, has been with the Journal for 6 years now, previously covered international economics for Congressional Quarterly here in Washington, and had a loose fellowship with the Japan Economic Journal in 1981 and 82. As you heard from one of our callers earlier, Mr. Murray is the co-author with Jeff Birnbaum of Showdown at Gucci Gulch. He has a BA in English Literature from the University of North Carolina and a master's degree in economics from the London School of Economics, originally from Chattanooga. Next telephone call for him as we talk about the U.S. economy and the stock market is from Jackson, New Jersey.
Hi, that woman took the words right out of my mouth. That's what I was going to talk about. But so then I'll talk about the reason that reconciliation between the House and the Senate was held up is because before that, the administration and the Congress had a deal. And the administration went back on that deal when they start bringing up the capital gains tax to the rich. Because, you know, if you look at that capital gains tax, that 80% of that tax is going to go to people, I'd say 60% over 200,000 and 80% over 100,000. I think it was a congressional, I forgot what they call it, budget. I don't know if it's the budget or what, but they said over a 10-year period we will be losing $64 billion. Now, who will make up that $64 billion? Won't it be the middle taxpayer who isn't getting anything out of this, but maybe $15 to $20 out of that thing? And
the sad thing about this is that the people who are going to make up that $60 billion you talk about are our children and our grandchildren. And that's what's really going on here. George Bush learned one very important thing from Ronald Reagan, and that is that it's good politics to cut taxes and it's not good politics to raise taxes. And that's why he's doing the capital gains tax cut, because we obviously can't afford with our budget deficit even small tax cuts, let alone large tax cuts. But this was the one that he thought that he could champion and make himself look like a tax cutter. And the sad thing is, nobody's going to pay for it. It's going to go into the deficit. We're going to borrow to finance it, and it will be, the way things are going, it will be the next generation that gets stuck with the bill, and that's very unfortunate.
Sandy, Utah, good morning.
Yeah, you complained earlier about our savings rate being low. You know, why should people have to pay taxes on inflated capital gains? And furthermore, you know, I think that ought to include like a savings account or any kind of a money that you put, you know, that you earn interest on. It ought to be indexed. You shouldn't have to pay on inflation, I don't think. And I saw your article about the capital gains tax in the Wall Street Journal on the front page. You know, and I also saw the debate in Congress. And you were saying basically the same things all the Democrats were saying. And yes, you were too. I can read and I can listen. You said the same basic arguments. I could list them off if I went over.
I know what article you're talking about, and you go back and you look at the people who were quoted in that article, and I guarantee you 80% of them are Republicans. And here's the thing that you're missing about the capital gains vote in the House of Representatives. What the House of Representatives did was say that you can get a tax break on capital gains on investments you've made in the past if you sell them in the next 2 years, but after that it's over. That's not what the administration proposed originally. That's not a proposal that's going to do anything to encourage investment or to encourage savings. All that is a windfall to people who've already made investments. It's not an incentive for the future. So it doesn't have the kind of incentive effects that Republican economists have advocated for quite some time. But let me make another point about savings. You're right. There's no reason why inflation should be taxed, and maybe indexing capital gains to make sure that inflation gains aren't taxed is a very good idea. But the point I was making was about gross savings, which is how much money is left for investment by American businesses. Now, you can cut taxes on interest, and you might be able to have a little bit of an increase in the amount of money people put in savings accounts, but unless you raise taxes someplace else or cut spending someplace else, you're also going to increase the amount of money that the government has to borrow out of that pool of savings. And that means you're going to end up with a smaller amount of net savings left for investment in business.
St. Augustine, Florida, good morning. You're on the air.
Good morning, Susan. Do you really want to know what's going on? Does he want to know?
Sure.
You really do?
That's my job.
Okay, honey. I'll read you a paragraph. This is from Karl Marx Capitalist by June Graham, Enterprise Publications, Oak Park, Illinois. She also wrote The Money Manipulators. But look, there's nothing anyone can do. So not to worry. Everybody just stop worrying, okay? The apex of our money system rests on the private issuance and control of money, credit, and foreign trade of every nation on earth. The IMF, International Monetary Fund, is in reality a sovereign above all nations. Its executives enjoy complete diplomatic immunity. They cannot be arrested or detained. The International Monetary Fund and its officers pay no income tax. The IMF has the power to issue new money for all member states, including the United States. Its directives become fully operational laws within member nations. The IMF is owned by individuals, not by countries. Article 2 of the IMF Charter made the delegates of the countries they represent the real owners of the world. This is one sovereign nation to which you can't apply for citizenship. You are nonetheless its subject. If you want me to read you from the bottom to the...
If I respond to all the things you've said so far, it will take us through the end of the show and beyond. It's about 90% wrong. The IMF is controlled by the member countries. Frankly, it's a paper tiger. If the IMF had its way, it would have forced the United States to get rid of its budget deficit a long time ago. But the IMF has no say whatsoever over U.S. policies, and that's part of its problem. It's a weak link.
Columbus, Georgia, good morning.
Good morning. Mr. Murray, I'm not an economist, but it appears to me that the intrinsic value of a stock is only the revenue it can produce from dividends. Is that correct?
Over the entire life of the stock, sure.
Okay, now some stocks have gone up in value even while showing paper losses over years and years, like in some of the airline stocks. How can a bunch of investors buying stocks from each other provide capital for business growth and thereby produce jobs? I've heard this for years, and I'd like an explanation for it.
I wish I could answer that question. I've heard the same thing, and it beats me as well.
We are talking with Alan Murray this morning. We've got about 17 minutes or so left with him, and we are trying to understand what's happening to the stock market. Are there any other events scheduled to happen this week that may have an effect on the stock market?
Well, actually, there's an announcement this morning on as we sit here, an announcement on the trade deficit, the latest trade deficit numbers, which could have an effect. I'm sorry, I haven't seen those numbers yet, but that's one thing that could have an effect.
I wonder, what time were they scheduled to be announced?
I believe they should be out by now.
I wonder, we might have a producer see if we can find the announcement on the trade figures, and you can help us understand what the result of those might be. And in the interim, we'll continue taking calls. The next one from Las Cruces, New Mexico. Good morning.
Good morning.
Caller, could you start again? We can't hear your call.
How are you today?
Fine, thank you. What's on your mind? Go ahead, sir.
Hello, can you hear me?
Yes.
Can you hear me?
Yes, we can. Go ahead, please.
I want to tell that young fella there from Wall Street about a poor man like me that works for a living that has been investing in the stock market for about 21 years. And these here rich tycoons that have been manipulating the market for many, many decades now. This just didn't happen in the last 5 or 10 years, but it's getting worse every year. And what has to happen in this country is somebody has to have the backbone, and they've got to finally, someone has to have a backbone, and they've got to finally pass some laws to protect the little investor. And if they don't, until then, I hope everyone does like me, gets out of the market.
Thank you, sir.
Well, I think that is one of the unfortunate things about this episode and the episode in October 1987 is that it has frightened small investors. It's convinced them that the casino is rigged, and it's caused them to get out. And as a result, you have more and more concentration among these big institutions, these big pension funds I was talking about, and fewer people who feel willing to put their money directly into the market by themselves. Now, I should point out, as I said earlier, a lot of people still have a big stake in the stock market, but it's indirectly. It's through their pension funds, through their mutual funds. People are afraid to play the game themselves.
I had, this is definitely a sidebar question, but one thing that has changed of late is all of the instantaneous media coverage of the market. See live camera crews on the floor of the market. Does it have an effect?
I'm afraid it has an effect on the Wall Street Journal. We have a lot more competition than we used to. There has been over the last, you go back 10 or 12 years ago, there wasn't nearly as much coverage of business and the economy. The New York Times business section only started, I think, maybe 12, 13 years ago, and gradually you've seen more television stations, cable stations pay more attention to this. I think it's because people are focusing more on the economy these days than they used to.
Can it, in the case of Friday, for example, when there's a sudden surge of activity, in this case it was negative, can instantaneous coverage of that trigger more?
It could, but again, remember, the real action here was not individual sellers like you and me. The real action was these giant institutions, which are getting plenty of information right there in New York. And so I'm not sure that the individual sort of retail customer really makes much difference.
Let's go to Columbus, Ohio next. You're on the air.
Thank you. I couldn't help but be interested in what you were talking about in terms of having to raise taxes and things like that. Don't you think that there is an absolute limit to what the economy can support in terms of percentages of G&P for taxation? I know that in 1941, Colin Clark made a pretty persuasive argument that if total government take on the economy exceeds 15 to 18%, you'd basically have a reduction in the total economic system. Could you care to comment on that?
Well, you may be right. The problem we face right now is that the political system has come to a conclusion about how much taxes the economy can bear, and the political system has come to a conclusion about how much spending is the bare minimum, and they're still far apart. And we have to figure out some way to bridge that gap. And it's not, at this point we seem to be at a complete stalemate. I'm not sure that if you did it half and half, it would have that much effect on the economy. I mean, there's certainly, most of the other countries in the world have much higher tax burdens than we do.
Schenectady, New York, good morning.
Yes, when there's a stock market crash followed by a gradual recovery, for most investors, it's all on paper. I mean, it just looks interesting on their PC screens. The losers are the relatively small fraction of the investors who sold on the day of the crash. My question is, about what fraction of the total value of the market is involved in the crash day transactions?
That's a figure that I don't have on hand, but you make a good point. I mean, even at the end of the day on Friday, the market was still up 20% from the first of the year. So people who've been in the market this year have done quite well, despite the crash.
All of our lines are lighted up. We have about 9 minutes left in our program, and I might also ask our caller, any of our callers who have heard some news reports on the trade deficit numbers that are out this morning, if you could share those with us, we'd appreciate it. Nevada, California, you're on the air.
Yes, thank you, and good morning. I happen to agree with the callers who are smart enough to know out there that it is the big Royal Casino, and I fault very much the press in general, and I fault the TV networks. The average Joe Blow in this country has no idea what the stock market is. They don't know how it works, and this capital gains thing is a fraud. So the best way to let somebody know is maybe I could ask you a couple of 3 questions, and rather than dance around it, just give me a direct answer. And let me ask, I have 3 questions for you. Then I'll hang up and listen to what you have to say. It's number 1, out of all the trillions of dollars that are traded around the various stock exchanges around the world, and they're all connected now, as you know, by instant communication with computers and blah, blah, blah. Of all those trillions of dollars, how much of that money goes for start-up companies as a percentage? That's number 1. Number 2, let's say that a company needing money to get started puts out its first public stock offering, its initial public offering, and the company gets $20 a share for that to operate on. And then the company flourishes, the dividends are great, the stock soars, let's say, to $50 a share. Now then, tell the public how much of that $30 increase goes to that company for additional operating expenses. And question number 3, when the casino gets manipulated into crashes, let's say that same stock plummets to $10 a share, okay? How much of a loss goes to the company out of that stock money, and who makes the $40 that was gained? Let's say that I had stock at $50 and I sold it at $10. Who takes the loss on that $40? Explain that to the public.
Thank you for the call.
All right, let me do my best quickly to hit all three questions. First, the question about startup companies. Very few startup companies are publicly traded. You really have a separate market, the venture capital market, that puts money into small startups. But the money comes from a lot of the same places. The giant pension funds I was talking about will have a certain portion of their investments that they put into venture capital, which pays for startup companies. Second, when you talk about a $20 to $50 increase per share, usually what's happening in a case like that is the company has made money, but instead of paying that money out in dividends, it's decided to keep it and invest it. The company has grown, and that's the reason that the stock value has grown. So in a way, that money is money that's been earnings that have been retained and reinvested. When the stock price plummets to $10 per share, obviously the loss is going to the person who holds the stock. But it's a loss to the company, too, because it makes it more difficult for them to raise new money. It may mean that they have to take steps to shore up confidence in their stock.
Alan Murray, let me read you the wire copy on the trade deficit story. This is from the Associated Press. The U.S. trade deficit, after falling for 2 consecutive months to its lowest level in nearly 5 years, increased to $10.77 billion in August, the government reported Tuesday. The Commerce Department said the August shortfall represented a 30.77% increase from a revised July deficit of $8.24 billion. The new number in the trade gap is $10.77 billion.
Well, that's certainly not going to make the markets very happy. I don't know what's happened this morning, but that's a big increase. Now, these trade numbers are very volatile. They jump back and forth a lot, and it's really a mistake to read too much into them. But that's the kind of number that could hurt the market a little bit today, and could particularly hurt the dollar.
Were you at all surprised by the overseas markets' response to the U.S.?
Well, I think the most interesting part of what happened in the overseas markets was what happened in Japan. Because the Japanese stock market dropped, but really surprisingly small amount in percentage terms compared to what our market did. And I think it was again an indication of the degree of control that the Japanese have over their markets. They can tell their big institutions to buy stocks, and they will for a while at least.
McAllister, Oklahoma, thanks for waiting. You're on the air.
Hello. I have 2 questions. Is the price-earnings ratio really valid anymore since there's so much interest, so much borrowed money? And the second is, if you could pass any laws to improve the stock market, what would they be? And I thought maybe that the interest could no longer be deductible, and that maybe it would take 5 years, and then you could get a capital gains break.
Interesting proposals. If interest is no longer deductible, you've increased the cost that companies have to pay for capital. There's a chance that by doing that, companies will invest less, you'll create less jobs, it will hurt the economy. So it's a very dangerous area that you're getting into there. Again, though, I'd go back to the proposal that's being looked at the Treasury Department. I can't advocate it because I haven't looked at it closely enough myself. But if you believe that the problem is giant pension funds that are too eager to move their money back and forth to go for any takeout artist who offers them a slight increase in the stock price rather than looking at the long term, there are people who believe that the way you might deal with that is by putting a small tax on transactions by these pension funds. Right now, they're not taxed at all. It's completely tax-free money. And there's been a suggestion, as I said, made by Senator Nancy Kassebaum of Kansas that you tax those if there's trading in the short term.
1 minute left. Colds Point, Virginia. You're our last caller.
Hello?
Your question, sir.
I'm a little nervous, so don't cut me off.
Well, we only have a minute. How about a quick question?
All right. If the people who are complaining about Wall Street being the big casino, all they have to do is move to a country that doesn't have a Wall Street, and they can see how life there is. I imagine the Russians and the Poles and the Hungarians would love to have a Wall Street that they could complain about. I'd like to have your comment.
Well, in fact, the Russians and the Hungarians and the Poles right now are spending a lot of time trying to figure out how they can get a stock market going. So I think you're absolutely right.
In the time remaining, have you perhaps suggest what the net effect? We've been talking so much about what the stock market has been doing. On the front page of USA Today, one broker said, this is a correction and there's definitely going to be a new level to come out of it. What it is, what that level is anybody's guess. Is that what you think is going to happen? Setting a new level for the market?
A somewhat lower level. It probably means you'll have somewhat less, for the time being, somewhat less takeover activity, somewhat less leveraging of companies. It means we're going to see interest rates a little bit lower because in response to the stock market, the Fed did ease credit a little bit. And it probably means that we're going to see the dollar come off a little bit, be a little bit lower.
Last question for you. We heard from a number of frustrated callers this morning. Are you surprised that people are feeling frustrated?
No, I think that's the most unfortunate effect of this type of volatility in the stock market. It makes people think. There was a time when people thought the stock market was very much a part of the economy and sort of represented the health of the U.S. economy, and I think that's disappearing. That faith is disappearing.
Come back again, will you?
Thanks, I'd like to.
Alan Murray covers economics for the Wall Street Journal, making a return visit here to C-SPAN. Have a good morning.